In this business, my work is based on the trust that my customers give me, and I can't lose this trust. If they ask me to customize something to make it this way or that way, I definitely have to deliver and make it happen.
Well, trust is the foundation of our business. We're not talking about a few thousands of pesos given to us for safekeeping. We're talking about hardworking folks like yourself entrusting with us billions of pesos to manage for them in a good and responsible way.
The challenge is to keep this trust, even though there are so many things that are beyond my control.
Because we need to make our clients' money grow. Like you, we do our research. We look at many factors: the economy, politics, what's going on abroad. All of these things affect business. But we don't want our clients to be left behind. We want to bring you to the forefront of new ideas. We want to bring you to industries that you may have never even thought of investing before. We want to do this for you and bring you to worlds of investing that you may know nothing about.
What is important to you is important to us too. Your values are our values. Clients know that we mean what we say. They have now entrusted ATRAM, a multi-awarded asset management company, with their investments. Each day, we wake up with fresh ambitions, wanting to do what matters to us, for people who matter to us. We do what we have to do. We live for today and work for the future. We are ATRAM. Your future, our present.
Hello and good morning, everyone. Thank you for joining ATRAM's first market update of the year. Hope everyone's having a good day and a better start to the year. We trust that you are all well and healthy. Today we'll be giving to you our 2021 investment outlook. I am Paolo Idilior, Business Development Manager at ATRAM. Our speaker this morning is no other than ATRAM's Chief Investment Officer, Phillip Hagedorn. Hi Phil, happy to have you back again. I can't wait to find out what's in store for us this 2021 with regard to investment themes and strategies.
Hi, Paolo. Good morning, everybody. Thank you for having me.
You're welcome. Let me now turn over the floor to you, Phil. You may now share your slides. There you go.
Okay, well, maybe before I get going here, first I want to thank everybody for joining us today. It's the beginning of the year, a new year, and I think we are optimistic and looking forward to the year ahead. No? We'll never forget 2020. I think it was a year that will live in its own infamy. With everything from natural disasters, the global pandemic that we're still dealing with, this new environment of work, stronger family bonds that we've spent so much time with our families, volatile markets. It's really been a very incredible year. And maybe just a quick update on ATRAM. We've come through the year very well, I think. Our AUM levels are over 130, well, ended the year at over 130 billion in assets under management. Although very volatile, we've had some awards given to us last year. We've had success in launching our digital platforms, where Seedbox today, we're on the verge of celebrating our 1 million customer, or 1 million sign up in the platform. So really a lot to look forward to. And what we'll do today is have a look at what we think the economy will do and the different asset classes that we're managing, what we expect from them, and some suggestions as to how you might want to approach the year in terms of investments. So let me begin first with, kind of key messages for today. And one thing is that the economy will continue to restart and recover. We had an outlook towards the end of last year that GDP growth this year would be in the double digits. We've tempered that outlook a little bit. But ultimately, we're still seeing a recovery, the country going to recovery phase uh, as we move along. Um, One thing that we're all looking forward to as far as companies are concerned is that they get back on the spending mode as far as investments are concerned. So the good news is that companies seem to have come through the storm in a healthy fashion, and will be able to, or at least have the ability to start investing again and planning for the future. Ultimately, what this means, we think, is that interest rates will remain low. So we have a view that we will continue to be overweight in the equities market. And we're also looking at alternatives as another asset class to improve the overall performance and yield of the portfolios. No? So it's all about mobility. And in the end of the day, I think the key message of this slide is that I'd say since about August, analysts in the industry, and not just ATRAM, but I'm talking about the street in general, has had a better feel of what the future will look like in terms of growth and where the opportunities are. The reason I say that is if you go back to the first and second quarter of last year, while we were in the height of the pandemic crisis and the lockdowns, it was literally like whistling in the wind. It was very difficult to get a sense of where economies and where companies would be and what the performance would look like. But I have to say, since about August, we've been spot on in our forecast. So we forecasted at that point GDP growth to be down around 9%, 9.2% for this year. And it looks like that's where we're going to end the year. We forecasted the fourth quarter accurately as well. And so the message, I guess, is that forecasts can be relied on a little bit more today than they could sort of 6-8 months ago when we were in the height of the pandemic and really had no visibility as to how long we would be there. Again, it's all about the mobility. And what we're saying is the reason we've downgraded a little bit. So from 11%, you'll see the numbers around 9% growth for this year, is that we are expecting GCQ to remain in the NCR through the first quarter. We had originally thought that by this time we would be in MGCQ, but in the GCQ scenario, there are still some controls out there, and we expect that to maintain at least through the first quarter. The epidemic is being managed. There are new threats with new strains and the like, but the chart on the right here shows the testing capacity, and you'll see that we have significant testing capacity, and that's good. We also have bed space and availability, specifically in the NCR, significantly below crisis levels in terms of occupancy rates. So we're well prepared to manage any moderate spike, I guess, post-Christmas, and that's what we're seeing now. But it looks to be very much under control. And obviously, the longer-term solution is the vaccine, but there's still lots of questions about more of vaccination rather than the vaccine. How do we roll out this vaccination process, and who gets prioritized, etc., is something that we need to understand sooner rather than later. But certainly, that tool is upon us, and we expect it to be the vaccinations to start in a more aggressive way by the second half of 2021. So, all in all, due to the delay in the opening up of the economy via the MGCQ status, we think that we've downgraded our outlook for GDP growth from around 11% to 9% next year. Just to back that up, as far as mobility numbers are concerned, this is Google Analytics data on NCR mobility, and NCR is still the engine of growth for the country. And we're still seeing significant, numbers that are still significantly below baseline, particularly on the retail and recreation side, obviously on the parks, which are closed, transit stations, workplace is volatile. You see that there are periods there where it's closer to the baseline, but it's still quite volatile. Transit stations, I think, is an important one because this is what's going to help people get back to work. So we need to see improvement here as well. There are marginal improvements over the long run, but still a ways away from our baseline, and this is what we look to make up starting this year. So what we said, we're downgrading our 2021 outlook on updated mobility assumptions. We do expect the new normal to be pushed back to the second half of 2021 as the new threat and the vaccine timeline is pushed back slightly. We have a forecast for the peso, which reflects new assumptions on the impact on US dollar demand, which we still expect to be a little bit benign, maybe improving in the second half of this year, but no strong demand in the first half. And keeping a strong eye on inflation. We're seeing inflation starting to move above 3%, and we'll talk a little bit about that, where there's some constraints on supply and some commodity pricing moving higher in the short term. So here are our forecasts. The chart on the right just kind of shows you where we were. So the shape of the recovery isn't changing much. It's just the steepness of it. And so a little bit more conservative with a forecast of 9.1% GDP growth next year, driven primarily by a recovery across almost every sector of the economy. And we see that continuing to stay elevated above 7% growth for 2021 as we head into a very important and what could be a very exciting election year ahead. We have to keep an eye on all these things still. So although we have our forecasts, I think the way things are moving along, we have to be ready to adjust at any given time. So really on IATF policy and the progress of the vaccination and the impact, the overall impact of the pandemic and any shutdowns is probably top of mind. Same thing with commodities and CPI inflation. We're seeing food prices rise, commodity prices rise. So we want to make sure that that's not getting out of control. We are importing rice from Vietnam, who's having their own struggles as well. So we are keeping a good watch on inflation and see that this doesn't get out of hand. OFW remittances, very important. The concern here is what's going on in more developed markets. I think the return of the lockdowns that are going on could have impact. So we have to wait and see. We will expect some growth from OFW remittances still this year. And glad to see that last year they exceeded expectations, because I think the street expected that OFW remittances would drop significantly last year. And employment and NPLs is also on the watch. Unemployment hit a high of 17% middle of last year, but has quickly come back, and now it's around the last print around -9%. What we want to see is the unemployment number trending back towards that mid to low single digit number, but we don't expect that to happen this year. But through the year, we don't expect also, and would not want to see us heading back to the double digit unemployment numbers either. So mobility is a key part of this. Construction is a key part of it. Today, there is an article from Fitch upgrading the outlook on Philippine construction. One of the challenges, though, is getting workers back into the NCR, because the Balik Probinsya program back mid-year last year sent many construction workers back to the province, and they're having difficulties coming back into town. primarily because of a lot of requirements on health and the lack of transportation. So these are areas that we would want to see addressed over the next few months if we expect public spending and construction to come back. Finally, I think on the supportive measures of the BSP, again, we're going to expect interest rates to remain low and the banks to remain cautious. We are waiting to see what the NPL numbers look like. There's an expectation of it staying sort of in the 5 to 6, minus 5 to 6% range. And if it comes out there, then I think that's well within expectations. But the Bayanihan program has just expired, so we will wait to see what stress that puts on the system over the next couple of weeks and months. So still a lot to watch out for, but like I said, quite optimistic that recovery is on track and will continue to move higher. Just some forecast on inflation, peso, and BSP policy. The inflation forecast is 3.1% for next year. This is higher than what we'd like to see, and it could go higher considering some of the actions that are going on offshore with commodity prices and oil as well. So we have to keep an eye on this. But this is again still within the BSP range of 2 to 4%. So we're comfortable with it. Just keeping an eye that it is at the high end of the range. As far as the peso is concerned, because of the weak demand for dollars, we're not expecting a lot of action there. Overall, we think the peso may depreciate by about 1% this year. So we're looking at a year-end target right now around 48.40. But again, I think for this to happen, we would need to get back on the spending side, particularly in construction, and that imports number will need to pick up as well. We're not expecting the BSP to cut rates, at least on the policy side, but we are expecting reserve requirement cuts, so they will remain accommodative and rates will remain low. And maybe looking at 2022 when we see rates moving slightly higher from the 2% we expect to see this year. So that's basically the short of it as far as the macro outlook is concerned. I want to now go into the different asset classes, and we'll start with our ATRAM Global Multi-Asset Strategy. This is our global strategy with a Philippine bias, obviously. So a large part of this portfolio is invested in the Philippines. And effectively, what we're looking on global themes for 2021 is an economic rebound, accelerated with above-trend growth as pent-up demand is unleashed. Now, what we do expect, though, is that this is going to be a lot more prevalent in the second half of the year. The first half of the year, because of the lockdowns, particularly in some of the developed markets, we probably will be behind the curve as far as economic rebound or GDP growth in Q1. But I think this pent-up demand, as we saw last year in the Philippines, the minute you allow the mobility, it is unleashed, and we'll expect to see that in the second half of the year. The fiscal and monetary stimulus will persist despite the risk of higher inflation. So again, central banks globally will continue to be accommodative and will keep rates low and allow for economies to recover. That's our expectation. And then we're looking at new trends, turbocharged structural trends that are a result maybe of what happened last year. E-commerce, digital, sustainable investing, ESG investing. These are trends that we don't think are fads. We think are here to stay. And we're looking at how to take advantage and invest in these opportunities as well. As far as the global fixed income space is concerned, we're going to continue to be active here, looking for quality corps, quality sovereigns to invest in. Many of the themes are similar in terms of what we like to see, the fiscal recovery on the vaccine rollout. We want economic data, although it's a bit fragile, to continue to show improvement. But number one is really containment of this vaccine, of this epidemic. No? And again, because the starting point is quite low, being active and making sure that we're in liquid positions to be able to be tactical and take advantage of markets as we move along. We do have the opportunity as well to invest in a fund for those that are not in our ATRAM global multi-asset moderate strategies or any of our multi-asset strategies. We have the ATRAM Unicap Diversified Growth Fund, which is capturing a lot of these ideas. That fund was up 6.7% last year. And it is a fund that's invested globally with exposure to global markets and local markets in the similar way that we talked about. So this is a summary. Again, global equities will be overweight, Philippine equities, overweight, underweight on global and Philippine fixed income, and a slight allocation to alternatives to help the returns overall. So we have a quite optimistic look on Philippine equities, and that's driven primarily by our outlook on earnings and the improvement that we expect to see in 2021. Last year, 2020 earnings is going to be down around 40%. Ultimately, in the first quarter, they were down 20%. In the second quarter, earnings were down almost 80%. Recovering to down 35%, and we will end the year at around a minus 40% number for earnings. And that's the main reason why we've seen the market so volatile this year. But I think one of the reasons why we've also seen a recovery in the market to, if I'm not mistaken, we're actually higher today than we were a year ago at these levels, is the outlook for earnings for 2021. And the outlook for earnings for 2021 is a recovery. And if you look at the chart on the left here, the large recovery that we're expecting is to come from the property sector. And I know many of you might think, well, how's that going to happen? There's very little sales going on. There's a lot of risk. People are not going to malls. The malls are changing their revenue model. That's correct. And I think that's the challenge for the growth part for this year and moving into next. But a lot of the earnings from property companies come from revenue recognition of projects that have started already. And we expect these projects to be completed this year. So much of this income is driven by income that we can see and expect. It's revenue recognition of sales that have happened. And as long as there's not many defaults there, then we're confident that this number can be met. What we want to see, though, for us to have more confidence looking forward to 2022 is that new projects are started at some point this year and companies are back on a CAPEX cycle. So we know, and if you didn't know, I think between the banks, the property companies and conglomerates, property and banks drive significant earnings of conglomerates in the Philippines. So these are all connected. And if property can deliver with the banks, we think earnings is going to be quite flat for banks, but that still doesn't take into consideration what might happen with NPLs. That we have a fairly firm outlook that we're going to see a recovery of around 44% in earnings. Now, the number might seem high, but overall, that will not yet get us to our all-time high earnings numbers, which we hit in 2019. We only expect that to happen in 2022. So we're on our way back, but not yet all the way back. Quickly looking at the different sectors and what's driving. So like I talked about property, it's the pre-sales that we're looking to start to pick up, but and mall expansions and mall traffic, we want to see all of that pick up this year. But the earnings is going to be driven primarily from projects that are being completed. So that has to happen together with the imagination of new projects starting and commitment of CAPEX for that. For the banks, it's all about the NPL. So you have to keep an eye on that. We're looking at the Bayanihan expiration and how that might drive the NPL number higher this year. We're not concerned at the moment, but it's something that we need to keep an eye on as the months come along. The telco sector is a sector that we've added exposure to. They're clearly more data, more digital, more communication is being used. This example of this webinars, it's been fantastic to be able to keep in touch with all of you. Last year, I think we did over 40 of these webinars, one a week. And, I think it's a fantastic way of keeping in touch with everyone. And I think the telcos are in the front line of all of this. So we do expect the third player to make a lot more noise this year. So we'll see how competition intensifies there. The consumer side, probably are most exciting for the second half of the year. We'll expect a return. We're seeing OFW remittances quite firm. We want to see the job numbers come back. And we're happy that we've improved, but we need to see that move towards 6% to get more confidence. And we have that election wild card for next year that should drive the consumer market in the second half of this year. So lots to look forward to as we round the corner for this year. Power, we're back to peak demand, basically. I think at the NCR in particular, we're back to around 95% of what we've been doing. So that's important. The restaurants, obviously, this have been big, very hard hit. There's a big mix. There's a new way of looking at them, I think, where what's the mix of delivery versus in-store sales that we're looking at. But I think, again, as the year moves along and mobility restrictions improve, restaurants should do better. Ports give us an idea as to the inflow of imports. This is what we want to see as well. And I think if we see that, then we'll be able to get a better sense of where the peso will be, where the current account might be, and where consumption might be, because a lot of these imports are also consumer goods that people use. So we want to see improvements there. Gaming, the last one, obviously mobility restrictions are keeping that at bay. But again, as that improves, we expect improvements there as well. So what's our view? Our view is the index fair value by the end of the year should be around 8,300. That is taking into the assumption here is obviously that we are able to achieve or be in the ballpark with regards to our EPS growth expectations for this year, that the Philippine GDP recovery is back on track, trending towards the 9%. That's the expectation that we have. Foreign ownership, we want to see the return of foreign investors, but I think that what's going to be the catalyst for that is going to be the start of any CAPEX cycle, because foreign investors are generally long-term investors. And I think what's going to excite them is if Philippine Corps can say, we're back on a new investment cycle. Investments equals earnings and earnings growth. And that's what all of us want to see, not just foreign investors, but us as well. And I think if corps are clear about that, then we're likely to see more inflow from them in the second half of the year. And finally, I don't want to state it enough, but those elections in 2022, right now it seems like a whole slew of candidates all wanting to fight out that spot. So it could be we could be entering a very exciting election season in the second half of this year. And if it's hotly contested, then certainly a lot of election funding should be flowing and consumption happening at that time. How to play these strategies for Philippine equities? We have a few different strategies and they all won't perform in the same way. And I think it's important you all know that. If you want to just have index exposure, then the best way to do that will be to buy the Philippine Index Fund, the smart beta fund. Of course, we do try to add value here by picking overweights and underweights with regards to some quant factors we look at, and that performed quite well. I think it was the second best performing index fund last year. If you want something with a little bit more core fundamental approach with some exposure to small mid-cap stocks, our Equity Opportunity Fund, or Soldivo, will be that fund for you. If you're looking for more growth, small mid-cap growth, Alpha Op, one of the best performing funds last year, will be the fund you'd like to choose. And we are launching a new sustainability fund, a fund that's anchored on companies that align themselves with the UN Sustainable Goals. This fund will be launched in February, and it's another strategy that you can look at. So mixing and matching right now, my view is that you'd probably want to be more core index oriented, because if the foreign flow comes back, those are the companies that are likely to see the lift. Maybe after that cycle happens and when consumption becomes a more important theme in the country again, then looking at alpha opportunity would be that. Of course, sustainability is a long-term strategy. It's a strategy that I think we're very excited to launch, and looking forward to sharing that with most of you, with all of you, and have it available on our deck by February for investment. So these are the different ways you can approach investing in Philippine equities through our ATRAM funds. Finally, on fixed income, again, we said that rates were going to be low this year and stay low, although we are looking at inflation as potentially the catalyst for rates to move higher. But again, where rates are today, tactically, we want to remain at the lower end or the shorter end of the curve. The index duration is close to 6 years, 5.61. Our portfolio today is much shorter at around 3.58. And I think the message here is, our total return strategy looks to remain nimble. We want to right now cut that coupon at the short end, but get ready to see if there are movements in the long end higher, that we're able to take advantage of that opportunity at some point without feeling the pain as far as any mark-to-market losses that we might incur if we were invested out in the long end of the curve. So the concept in Philippine fixed income is to be nimble, to remain conservative right now in the short end, but to get ready to move at any given time with the opportunity opens up. For those looking for a more stable return, the corporate bonds is one way to look at it. Our corporate bond fund last year delivered a very consistent 3% and expected to do that again this year. It's the right cycle, so we're in an economic recovery. Employment hopefully will start to pick up. Corporate earnings are starting to recover. The policy to support to keep rates low is still in place, and interest rates remain low and stable. So really for corporate bonds, the issuances remain robust. This market is growing and growing every year. 387 billion in new listings, 50 separate issuances, 27 issuers. Rates are fair, average yield of around 3.5%. And really, our portfolio has a yield of around 5.15%. Obviously, that's before taxes, etc. But it's quite a sticky yield. And if you're looking for very safe and predictable returns next year from fixed income, the corporate bond fund is likely to give you somewhere in the 3% after tax and all the rest range. No? So in summary, we have adjusted our view, but are still optimistic. to 9% GDP growth this year. Still a very good number, but lower than what we thought originally. The restart might take a bit longer, but it's good to see that companies are starting to plan beyond just 1 year. And CAPEX numbers are going to be critical for us to understand what the potential of this planning will be. We are looking at risks, obviously, still, commodities and inflation being number one, and a firm peso and how that impacts us overall, at least for the first half of this year. And then again, a low yield environment where we will be very tactical with fixed income and remain overweight on the equities markets with alternatives and commodities to help the return. So I think I've covered everything I need to cover today. Again, happy to take questions from the floor. I hope I was clear. And Paolo, if there's anything you want to start with, I'll stop sharing and we can get back on it. Thank you. Thank you again for the chance to present our views today.
All right, thanks, Phil. But before we go to the questions, let me just introduce our client services officer to let our audience know how to invest in our funds. So may I call on my colleague Nika to tell us how to invest in ATRAM funds.
Good morning, everyone. To open an account with ATRAM, just visit our website at atram.com.ph. Here, you can learn more about all the funds we offer. It will then guide you to our online investment platform, Seedbox. But if you have more questions, visit the website's frequently asked questions page, or ATRAM Academy page as well. It's as simple as that, so I hope you do visit our website at atram.com.ph. Thank you.
All right, thank you, Nika. Thank you, Phil, for giving a very comprehensive and informative market outlook and strategies. To our audience, please keep the questions coming. Remember, questions you send can help you win ATRAM merch. Our ATRAM merch is also eco-friendly, as we at ATRAM support the UN's Sustainable Development Goals. So let me start off first, Phil. I know you don't have a crystal ball right in front of you, but what do you think will happen now that Biden is the president of the United States to the developed markets and interest rates?
Well, it's the blue wave scenario, right? So the blue wave scenario is one scenario where we expect the U.S. To pass a lot of policy measures and actually be able to pass them because they have both the House and Senate. That's a lot of fiscal stimulus, right? So the initial rhetoric we're hearing obviously is mostly around the pandemic, a lot of spending around the pandemic. But that conditional cash, right? They're looking at giving everybody $2,000 again. That might actually be positive even for OFW, Filipino OFWs, right? Because that's cash that could be used, could be sent here. So democratic governments have proven also that markets do well in their cycles. So it's not like, this thing of, you have to cut taxes only. Clearly, U.S. markets have done very well already. So I think that we're expecting to see some consolidation there. But I wouldn't say it's because Biden wants to spend a lot of money on building roads and bridges and on the vaccine. I think it's just bound to have some sort of consolidation or correction. But the longer term is still very, very good and optimistic. So I think we would expect some consolidation, some selling, maybe on the news of tax cuts being reversed and things like that. But I would look at that as a buying opportunity, and maybe at this point we're underweight. So that's what we would like to see.
All right, thanks, Phil. So since we're on the topic of the U.S., can we go back to our global multi-asset portfolio just to get a bit of clarification on the global multi-asset portfolio?
Yeah, so that's a discretionary. That global multi-asset strategies are discretionary strategy. That's the strategy that we offer customers with investment management accounts with us, no, and institutions. Um, so, if you want access to that strategy, you need to talk to our sales folks for that type of account. The Unicap fund strategy is a similar strategy. It's not, I haven't highlighted or done a big deep dive into that strategy. We're happy to do that one of these days. But as you can see, the performance has been quite similar to what our discretionary global multi-asset strategies are delivering.
All right, thank you. Now, what is your outlook on dollar fixed income bonds and corporates as well as dollar perps?
Ultimately, people are asking, so what's the expectation of returns? And I think, 2 to 3% is where they're going to be. Um, uh, you know, Returns can improve, but you have to be very careful because rates are so low that the first move is going to be for rates to go up. And when rates go up, you take mark-to-market hits. So, it might be a year of two periods, right? Where in this first period, you're kind of just staying conservative and cutting the coupon of the short-term rates that you're in. And if we see growth come back, if we see the capex cycle come back, and if we see control in this virus, then I think the second half, you might see inflation move higher and you might see rates move up. And that would be the opportunity to then maybe improve the return on the portfolios. So ultimately, don't expect too much from global fixed income. I think if you can get 2 to 3%, that's the ballpark that we're looking at this point.
All right. On that note, I think I'm also curious about this question. With the current market outlook, where is the best market to invest in? Philippines, Asia, Europe, or US?
Well, I think it proves that you need that diversification. Now, based on our return expectations, the Philippine equity seems to be the highest return, but it's also the highest risk, right? So, we have an outlook that's good. We have an opportunity there. The way I look at the Philippine market is that we are at the level that we were in 2014. Matter of fact, 2017. So if you look at it from an economy standpoint, Paolo, I'll just put some numbers to this, right? Our economy peaked at $377 billion in 2019. That was the size of the economy. And prior to that buildup, our market peaked at 9,000, right? That was an all-time high. Last year, we lost around 9%. So our economy is going to drop to around $343 billion this year. That's the drop from 377 to 340. That is higher than when in 2017, when our economy was at 328 billion only in 2017, but the market was already at 7,000 at that time. That was the first time that the market made that move from 7,000 to 9,000. So for me, I'm saying all that value that we've created, even if we destroyed a little bit of it last year, has been built up, wherein the economy today is bigger than it was in 2017, and a new starting point because the expectation is recovery, and the market is still at that level of 2017, right? So I think we're at a stage where the foundation that we've built through these years has kept us whole, and we can build off of that so that the expectation by 2022 is that the economy is back to 373 billion, almost to the 2019 number, almost the same now.
Right.
And most especially if we're going into a new investment cycle, that's when you want to buy stocks because that's when you see that you can have earnings growth come back over the next few years. If you're not going to invest, if I'm going to buy a yacht of land purely because I like the projects they're finishing and they're going to collect all this money and maybe pay a dividend at the end of the year. Why am I going to buy the stock? I want to buy it because, okay, that's good for this year, but they're starting new things and they're thinking about how to start operating and building out again beyond 2021. And that's what's important.
Yeah. Thanks, Phil. Interesting you mentioned economic recovery. We have a question. What shape do you forecast? Is it a U shape, V shape, I shape, or others?
I don't know, man. Our shape is kind of weird. It's like a U, I guess. Well, last year we said, in the beginning of the pandemic, we said we will recover by 2022, the whole economy. I think we're still on track for that. We were a bit hopeful, maybe naive, to think that it could happen sooner because we just weren't sure about how this economy was going to go, right? I mean, in July of last year, June, July, we were all on lockdown and we had no idea. But I think we've gotten a better sense. And today, more secure about our view and our optimistic outlook about the recovery. It's a U, I guess. It's the closest I could to a shape, I guess.
Thanks. A bit of a shift here, and it's been making waves lately. Can you comment on Bitcoin as an opportunity and other alternative investments?
Well, on Bitcoin first, I mean, we've had a lot of debate internally, and obviously clients are interested in it. We're trying to find ways to provide it if we can. Personally, I don't own any Bitcoin. I am understanding it. I see the value of the technology. I have trouble understanding why that one coin will be the only coin left standing. But we have very healthy arguments about, not arguments, debates within our investment team. And I think all those a little younger than me are a lot more, have a lot more ideas about how it'll be used in the future.
Right. And needless to say, they can catch our webinar on Bitcoin on our YouTube studio, ATRAM studio channel for more information.
Yeah, we had a good webinar there, and I think it offers some good advice and ideas to, large global asset managers are now allocating to the Bitcoin. But, they're allocating 1% of their 1%, maybe 2%. So to me, that would be probably a fair way to start your thinking about it. Don't throw all your eggs in that basket, but the best way to learn exposure about anything is to dip your feet in it, and that's something to think about.
All right, maybe a few last questions here. Do financial institutions' performance affect the performance of markets? If it improves, how can the merger of BPI of its subsidiary BFB affect the market?
Well, I mean, for BPI, it's about how they maximize the resources, right? I mean, you need to have two banks when you can do the same thing from one umbrella and have the same messaging and have the same. So, I mean, consolidation is something we're expecting to see. I think in the last crisis, it's interesting because I was looking at some of this data. Can you imagine in the Asian financial crisis, even as far as close as 2010, I think, BDO didn't exist, right? It was Equitable PCI Bank. And there were these mergers, Far East Bank. These periods allow for these mergers to happen. The banking system has always wanted more consolidation. So I think it's in line with the BSP's push to consolidate as well. Does that mean BPI's stock price will go up? I don't know. I think they've made a very exciting announcement. I think TG Limtauco coming in as the president of BPI. He was the president of BPI Family Bank at one point. He's consumer focused. We're looking forward to that. We've increased our weight in BPI overall. I think, supportive of that decision and that move, and congratulate TG actually for that.
Yes, indeed.
Upfront.
Phil, I'm down to my last question. Is the global or US tech sector due for rationalization or correction, hence our underweight US? And a follow-up to that is, will income stocks be safer in 2021?
I wouldn't want to bet against US tech. Last thing you want to do is bet against the US and technology. But having said that, it's had a good move. So is it due for a bit of a consolidation? Yes. Long term, is it a sector you need to be invested in? Absolutely. So that's how I would frame that. Income, well, it depends. Income comes from dividends. And, last year there was high expectations of dividends and not everybody delivered because income was all over the place. So depends on the structure of that fund. If it's coming from more of a utility base where the income expectations are more predictable, then great, yes. But if it's because last year, depending on the source of the income, I guess is what you have to look through.
All right, and I think that's all the time that we have for questions. Don't worry, we will be answering your questions privately. And now we can announce the winners of our eco-friendly ATRAM merch. Thank you for asking your questions. The winners of our raffle are Mark, Paolo, and Marlene. We will contact you directly through email. And you win a ATRAM intelligent alcohol spray wherein you hover your hand over and then it gets sprayed with alcohol. So it's also eco-friendly. So thank you, Phil, for your insights.
Thank you, Paolo, and I hope you all got something out of this today. Just know that we are here. ATRAM, we're working from home. We're taking care of our employees. But looking forward to getting back in the saddle and really looking forward to an exciting 2021 ahead. So thank you all.
Thank you, Phil.
With us.
And to our audience, thank you for your questions. If you have any further questions or would like to learn more about ATRAM's funds, strategies, please get in touch with your relevant ATRAM relationship manager or visit our website, www.atram.com.ph. In case you have not registered for our webinar next week, Ask ATRAM Wealth Portfolio Management, you may do so by scanning the QR code flashed on your screen, or you may also type in the link found on the left side of your screen. We also have webinars lined up for the rest of the month, so please check our social media pages. We would also like to invite you to join ATRAM's new official Viber group, #ATRAMPH community, to stay updated on the latest announcements, advisories, and reminders. Scan the QR code or visit the link found on the bottom right of your screen. And that's all the time that we have for this webinar. Thank you again, Phil, and of course to our audience. We appreciate you taking the time to join us. And if you have friends who you think would like this webinar but are unable to attend, feel free to share the YouTube replay of this session. Visit our YouTube channel, ATRAM Studio. Lastly, please answer the survey at the end of the session, as your feedback continues to bring value to us. We appreciate you taking the time to join. And on behalf of ATRAM, I would like to wish for the continued good health and safety of you and your family. Thank you very much and have a nice day.